What if everything you thought you knew about money is about to change? We're staring down a $324 trillion global debt crisis, a monster number that's growing by the second. Forget what the news tells you about small fixes. This isn't a bug in the system, it's a fundamental breakdown. Think of it less like a computer glitch and more like a total system failure. Aging populations and shrinking workforces aren't just demographic trends. They're the nails in the coffin for the old way of paying off this debt. But while most are just starting to worry, the ultra-wealthy aren't just talking about it. They're already executing a financial survival plan that bypasses the traditional system entirely. This isn't your grandma's investment advice. It's a complete wealth restructure designed for the coming storm. The critical question isn't if things will change, but whether you'll be ready when the financial ground shifts. So, how did we even get to this $324 trillion mountain of debt? It wasn't overnight. The cracks really started showing during the 2008 financial crisis, exposing some deep flaws in the global system, and things just kept escalating, especially during COVID-19. Governments responded to both crises by printing money and bailing out failing institutions, adding trillions to global debt. This approach traces back to 1971, when the US abandoned the gold standard, a pivotal moment that removed constraints on money printing. Debt began growing exponentially as policymakers assumed future economic growth would make it manageable. But now, we're hitting a wall with shrinking workforces, unable to support that growth. Japan's 3 decades of stagnation offer a preview of what's coming globally. Their economy flatlined due to too many retirees supported by too few workers, a demographic imbalance, making social programs unaffordable. The numbers reveal the scale. Where 10 workers supported each retiree in the 1950s, today's ratio is 3-to-1, potentially dropping to 2-to-1 by 2050. This structural shift renders traditional debt solutions ineffective. Raising taxes on fewer workers causes stagnation, while spending cuts harm growing retiree populations. Governments rely on temporary fixes, like the Federal Reserve buying its own debt to manage interest payments. But these measures ignore the permanent workforce shortage. Birth rates keep falling across developed nations, and immigration can't fully offset the trend. Japan's experience proves stimulus packages fail without addressing demographic decline, a lesson playing out globally today. Retirement systems built during population growth now face collapse. U.S. Social Security funds may run dry by 2034, mirroring vulnerabilities worldwide. These systems relied on perpetually growing worker contributions, an assumption that no longer holds. Smart investors recognized these trends decades ago. The 2008 crisis revealed the need for new financial systems, prompting wealth managers to allocate to unconventional assets. Cryptocurrency emerged post-crisis, while AI development accelerated alongside undeniable demographic challenges, not coincidences, but responses to a failing system. The IMF's April 2025 report warns aging populations threaten global fiscal stability, requiring international cooperation. Yet progress lags as debt grows, prompting major institutions to participate in once unconventional alternatives. The pattern is clear. Traditional approaches can't solve structural demographic and debt challenges. But the debt isn't the only problem. Remember how we talked about hitting a wall with shrinking workforces? That brings us to a critical piece of this puzzle that most people aren't connecting: the demographic time bomb. Let's meet Sarah, a 45-year-old nurse in Germany, whose story shows how this plays out in real life. She's one of 3 workers supporting her retired parents and in-laws through taxes, a burden that will grow heavier as her own retirement nears. This isn't an outlier scenario, it's the reality of demographic math. Global fertility rates have plummeted since 1950, with South Korea hitting 0.78 children per woman, far below the 2.1 needed for population stability. Meanwhile, retirement periods have doubled since 1950, stretching economies like a tipping scale overloaded on one side. The numbers tell the story. Where 100 workers supported 20 retirees in the 1950s, they now support 35. By 2050, that ratio could reach 100 to 80 in some countries. Germany already spends 25% of its budget on pensions, and the U.S. Social Security Trust Fund will deplete by 2034 without changes. Automation was supposed to bridge this gap, but productivity growth slowed despite technological advances. Investors spotted the mismatch early. As birth rates collapsed, AI funding surged, not as a coincidence, but strategy. Wealthy backers targeted startups solving labor crunch problems. AI for elder care with fewer nurses, or personalized tutors for understaffed schools. The World Economic Forum notes 75% of companies plan AI adoption within 5 years, partly to counter workforce decline. Traditional retirement plans assumed perpetual population growth. Japan's 3-decade stagnation after its 1990s workforce peak shows what happens when that assumption fails. Now, the IMF projects developed nations will face worse dependency ratios than developing ones by 2050, with Africa as the sole exception. The financial strain is undeniable. Retirees draw pensions instead of paying taxes, while aging populations spike healthcare costs. Raising retirement ages or increasing immigration could help, but both face political hurdles. AI offers another path. Microsoft's research suggests it can boost productivity by 30%, making it indispensable for shrinking workforces. The consequences ripple beyond economics. Schools close as child numbers drop. Housing markets slump without young buyers. Innovation falters without useful entrepreneurship. While AI can fill the gaps, it can't replicate the energy of a growing population. For ordinary people, this means 20th century retirement plans may fail, and social programs will strain. But opportunities exist in AI, elder care, and remote work. The old rules no longer apply. Demographic shifts are permanent. Adaptation isn't optional, it's inevitable. The only question is how. With the workforce shrinking and the debt growing, how do you keep an economy running? This is where smart money is placing big bets. As traditional workforces shrink, our reliance on technology must grow even more dramatically, and investors see AI as the key to unlocking that much-needed productivity. Japan's experiment with robots couldn't solve its economic stagnation alone, but AI now emerges as the missing piece. Unlike single-task machines, AI learns and adapts across entire job categories, offering unprecedented flexibility for workforce shortages. Sophisticated investors are directing billions into targeted AI applications. The first targets whole office jobs, legal assistants, data analysts, customer service, not just factory work. The second focuses on medical AI to help fewer doctors care for aging populations. One system reviews scans faster than humans with equal accuracy. The third is AI tutoring that customizes education amid teacher shortages. Microsoft found AI currently boosts productivity by 30%. The real potential? Making each worker exponentially more productive. A graphic designer using AI tools might produce 10 times the output. An accountant could review 100 statements in the time it took to do 10. The timing is critical. By 2030, when labor shortages peak, these systems will mature just as demand surges. Investors see what robotics couldn't solve. Machines excel at repetitive tasks, but falter with unpredictability. AI changes that. A robot arm can't draft a contract, but an AI model could. Healthcare reveals how targeted these investments are. In Japan, an AI fall detection system alerts caregivers when elderly patients stumble, preventing costly hospitalizations. Similar precision appears in education AI, where programs adjust teaching speeds to individual students. Past technologies like steam engines followed a pattern: disruption first, then productivity leaps. AI may mirror this, but with one difference. It arrives precisely when demographics make efficiency essential. Unlike robotics, many AI applications run on existing devices, lowering adoption barriers. Investors aren't spreading bets evenly. They prioritize AI addressing immediate shortages, healthcare, skilled trades, transportation, over abstract solutions. The 30% productivity gain matters because small improvements compound. If one worker does 30% more, that partly offsets needing fewer workers economy-wide. Japan's robot-dense yet stagnant economy proves partial solutions fail. AI's broader impact, augmenting humans across fields simultaneously, explains why investors are shifting strategies now. The race isn't just to automate, but to reinvent how shrinking workforces sustain growth. But AI isn't the only tech shaking things up. Remember that 2008 crisis we talked about earlier? Right after banks were collapsing under the weight of bad loans and risky bets, something else emerged: Bitcoin. It was designed as a direct response to that broken financial system, with one rule changing everything. Only 21 million Bitcoins will ever exist. No central authority can alter its limit. History shows why this matters. Fiat currencies typically fail within decades. Germany's Weimar Republic saw hyperinflation render its currency worthless in the 1920s. The US dollar has fared better since leaving the gold standard, but faces growing pressure from debt and money printing. Bitcoin's fixed supply offers an alternative, functioning like digital gold, with a built-in safety lock against inflation. This became clear in countries with failing currencies. When Venezuela's inflation hit 1,000,000% in 2018, Bitcoin trading surged as locals protected savings. Argentina saw similar adoption during peso collapses. These cases proved Bitcoin could store value without relying on banks, a feature now attracting institutional investors. Fast forward to today, BlackRock manages billions in Bitcoin through its spot ETF, while Fidelity offers crypto services. Major firms once dismissed Bitcoin, but now treat it as serious portfolio insurance. Wealthy investors allocate 1 to 5%, not for quick gains, but as a hedge against system failure, a pattern repeating when financial stress emerges. Bitcoin thrives during inflation because its supply can't expand like fiat currencies. More dollars chasing goods raises prices, but Bitcoin's fixed cap preserves scarcity. This digital gold property appeals to investors wary of currency devaluation, with the added benefit of global transferability. Modern investors echo these lessons. Conservative portfolio managers now supplement gold with Bitcoin, valuing its lack of correlation to stocks or bonds. The blockchain's decentralized ledger, uncontrolled by any government, adds resilience absent in physical assets. Critics cite volatility, but Bitcoin has maintained purchasing power better than inflating currencies. Price swings reflect its youth. As adoption grows, stability may improve without sacrificing scarcity. The original vision shines brightest during crises. When banks fail, Bitcoin offers a borderless alternative. Bitcoin's economic proposition remains unique, program scarcity in a world of expanding central bank balance sheets. Whether it succeeds long-term is uncertain, but its creation addresses 2008 systemic flaws, concerns still relevant amid today's rising debt and demographic pressures. So, we have AI tackling productivity and crypto offering an alternative to traditional money. But what happens when you put them together? AI and cryptocurrency actually share a fundamental purpose. Both seek to replace human fallibility with the reliability of code. And that's where things get really interesting. AI algorithms make decisions without bias, while blockchain protocols execute transactions without banks. These technologies represent a shift towards systems governed by mathematically verifiable rules, rather than human judgment. Microsoft demonstrates this convergence by using blockchain as a transparent vault for AI training data. Each dataset gets permanently recorded, ensuring its authenticity before feeding AI models. Without this verification, corrupted data could distort AI outputs, a critical safeguard blockchain provides through its unchangeable ledger. The synergy extends to infrastructure. Cryptocurrency miners already possess the powerful computing resources AI requires. Many have repurposed their mining facilities for AI workloads, since the same hardware that solves Bitcoin's cryptographic puzzles can efficiently run machine learning algorithms. This flexibility allows operations to pivot between crypto and AI based on profitability. Emerging platforms showcase deeper integration. Some use AI to automatically rebalance crypto portfolios by analyzing real-time economic data, bringing quantitative strategies, once limited to hedge funds, to everyday investors. The AI handles complex analysis, while blockchain enables instant, transparent settlements without banks. This convergence creates systems independent of traditional finance. Picture a decentralized cloud platform where users rent computing power via crypto payments, with AI managing workloads continuously, no central authority required. Such platforms already exist, demonstrating how these technologies form a self-sustaining economic framework. Major players recognize this potential. IBM combines blockchain with Watson AI for supply chain tracking, while NVIDIA develops chips serving both industries. Even BlackRock explores tokenized assets and AI analytics. Venture firms like Andreessen Horowitz invest in both sectors simultaneously, treating them as interconnected pieces of a new digital economy. Practical applications reveal the transformative power of this union. Blockchain networks like Bitensor create decentralized AI marketplaces, where algorithms compete for crypto rewards. Chainlink's oracles feed reliable real-world data to both smart contracts and AI systems. Together, they address key challenges. AI counters productivity declines from shrinking workforces, while crypto offers inflation-resistant alternatives to fiat currencies. Consider an entrepreneur in Argentina, where inflation exceeds 100%. She uses an AI service, paid in stablecoins, to manage her export business, bypassing banking delays and currency devaluation. The AI optimizes logistics, while blockchain ensures instant, borderless payments. This isn't speculative. It's the emerging reality where AI and crypto jointly overcome traditional system failures. From decentralized governance via DAOs to AI-generated NFTs, these technologies enable new economic models untethered from corporate or national structures. Their convergence doesn't just improve existing systems, it builds durable alternatives where code replaces trust in fragile institutions. Understanding AI and crypto shows us where some investors are looking for solutions today. But to really grasp the potential outcomes of this debt crisis, we need to look back. History shows us that major debt crises tend to resolve in one of three painful ways. First, austerity. Governments cut spending and raise taxes, often triggering economic pain. Greece's 2011 measures spiked unemployment to 27%, leaving families struggling as protests filled the streets. Second, inflation. Central banks print money, eroding savings. Germans in the 1920s needed wheelbarrows of cash for bread, as hyperinflation made banknotes worthless. Third, default. Governments refuse payment. Argentina's 2001 collapse left citizens scrambling when global credit vanished overnight. The 2008 crisis dodged these outcomes temporarily through extreme measures, near-zero rates, quantitative easing, and bailouts. But with global debt now at $324 trillion, IMF 2025, and rising interest rates, that playbook may fail. Central banks' bloated balance sheets show diminishing returns. When options narrow as debt mounts, high debt corrodes currency stability. When government debt exceeds 100% of GDP, currencies typically weaken. Japan's 260% debt to GDP ratio and America's 130% loom as warning signs. Economic theory suggests such levels eventually force painful choices. The longer delayed, the sharper the adjustment. Each resolution path creates distinct investment landscapes. Inflation favors hard assets. Gold surged 25% during 2020 money printing, while real estate and Bitcoin gained as inflation hedges. Austerity breeds alternative systems. Greek towns created local currencies as cash vanished, mirroring today's crypto solutions. Defaults bring chaos. After Argentina's collapse, citizens hoarded US dollars as pesos became worthless. Smart investors prepare for all scenarios simultaneously. Institutions buy both gold, inflation hedge, and Bitcoin, system failure insurance. Hedge funds position for currency devaluation while holding credit crunch-resistant assets. Debt crises unfold slowly, then accelerate suddenly. Japan's stagnation lasted decades, but Germany's 1923 hyperinflation erupted in months. Britain left the gold standard overnight in 1931. Today's added complexities, aging populations, digital bank runs, global contagion risks, may accelerate future reckonings. The constant across history. Wealth migrates from weak stores of value to strong ones. Cash flees to hard assets during inflation, necessity goods during austerity, and whatever remains credible after defaults. Prepared investors don't predict outcomes. They position for multiple possibilities, understanding that debt crises always resolve, but rarely as policymakers intend. That $324 trillion debt figure is a meltdown warning light flashing on the global economy's dashboard, growing by $7.5 trillion last quarter alone, per the Institute of International Finance. This isn't just about markets, it's about your wallet. When traditional systems wobble, smart money moves toward AI tools and crypto. But the real power move is understanding these shifts early. If you want to stay ahead, hit subscribe. We decode financial chaos weekly in plain terms. Now, we want to hear from you. What money trends keep you up at night? Share your stories below. Let's tackle them together.